G'day expats and welcome to another episode of Expat Chat, episode 117. We are getting those numbers up, no longer rookie numbers, they would say. Today, I'm joined with my co-host, friend, business partner, colleague, mentor, and I suppose the man from the desert or the sandpit, Brett Evans. How you going, Brett?
Mate, I'm well, thanks. I'm well, and it's getting a bit temperate here right now. Summer's on the way, not quite here just yet, but things are building up. And to the folks watching and listening, thank you for your time and attention. Gentleman working with me, in consultation with me and in partnership with me is Mr. James Ridley, who's the Managing Director for the Australian office, business partner, Muse. He's a qualifier of my crazy ideas. You know, he tells me I'm being an idiot if I try and think of some wild and wacky stuff or what I'm on the money. So he's like the smarter, better looking, more technical version of me.
I like it. I'll take it.
Hey, mate, what are we talking about today?
Mate, let's bust a few myths again. Far out. I feel like we've done this one a few times.
Yeah, a big kick's coming up. That's why I said let's do it again. It's not getting through to people. So
I feel like the budget a couple of years ago has thrown people off the scent and they think it's been legislated. So we'll jump into it again. But we're going to talk about self-managed super funds, SMSFs, and why an Australian expat, non-resident, should not have one.
Bingo. And the reason we're reiterating and talking this again is because we still have people coming to us saying, my accountant said I can do this, you know, my advisor said I can do this. So, mate, I think let's really just look at the people know what an SMSF is. If you have one, you know you got one. If you don't have one, you know have one. So let's get technical a bit quickly, but before I do, let's tick some boxes and keep all the compliance officers of the world happy. All the information we've got to talk to and share with you guys today is informational, educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, speak to a specialist like ours.
Yes, absolutely. And I mean, jumping into a self-managed super fund, you're right. If you have one, you will know because you run it, you manage it very differently to a typical retail, normal industry super fund like an Australian Super or Hester or CBUS, whatever have you, the ART. You'll know if you have one. It will be pretty clear if it is an SMSF, and there's essentially three tests that you apply, to determine, I guess, an Australian super fund. First and foremost, test one, was the fund established in Australia? And that's a pretty straightforward one. All SMSFs are established in Australia.
That's right.
Exactly. Test two, central management and control of the fund is ordinarily held and maintained in Australia. So that's the second test. And the third test, the active members test. So three very important tests. Test one is usually always a big tick. Tests 2 and 3 are probably the most difficult in probably the barrier or hurdle which a lot of Australian expats face if they have an SMSF and they shouldn't, because it's very hard to satisfy both those tests. And, we'll deep dive into them a little bit soon, but there are very punitive measures which the ATO take if they deem you to be running a non-compliant self-managed super fund. And the punitive measure is they will tax you at the highest tax rate in Australia, which is 45%, not including the Medicare levy, not on the income, but on the assets. So if you got 2 million in there, they're taken just shy of $1 million. That's right. And then they'll give you 12 months to wind it up. If you haven't wound it up, they'll hit you again. So very punitive. It's very rare that they'll give you some sort of flexibility or freedom. I think the only time I've seen them give some sort of longer transition period is one of the members of the SMSF actually had cancer and essentially had about 18 months left to live. So that's, I guess, a really unique scenario, but you really need to be mindful of, I guess, this SMSF residency minefield and what's going to happen in the event you're running a non-complying SMSF.
You're spot on it. And we see time and time again, good professionals, advice and accounting and finance professionals in Australia not understanding the ramifications of what they might think is a solution. First of all, if your time overseas is going to be less than 2 years, you're okay. We have what's called a temporary absence test that says you don't have to make any changes within that 2-year period. But think about it, as we know, we talk about it all the time, to become a non-resident, you have to go overseas for more than 2 years. So if your intention is to go overseas and become a non-resident for a period of greater 2 years, you're better off just dealing with this now as opposed to waiting for that, sort of 21-month period, maybe scramble trying to wind up a fund, because it's not quick and not simple. The other thing too, I think we need to talk about is when people do reach out to locals, and I'm talking about local advisors and accountants in Australia, please qualify them. It's something that we people think they're getting advice, and you just need to ask a couple more questions. So if you're talking to a financial planner, ask what percentage of your client base are expats. If you've got 1 or 2 clients, it doesn't make them a specialist. And 97% of their focus is on domestic people. They're not dealing with stuff on a daily basis. If you're talking to an accountant, a lot of brilliant accountants out there, and g'day to the accountants out there, they do domestic work really well. If they don't have a financial services license, they're actually not legally allowed to provide advice on a self-managed super fund. So they might be your auditor, or you're a local accountant who does your tax returns, who does your audit for your self-managed super fund. But it doesn't mean that they know the nuances between these rules, because we see the explosions going off all the time, and people but I spoke to Fred, or I spoke to Jane, and they said, I put my sister or my parents as a trustee, and they said it's fine. I had an email last week from a client who I'm sitting there going, your clock is ticking to 2 years, and then the response was, the financial advisor who's been running it up until this point said, don't worry, because legislation is about to be passed by the federal government extending it out to 5 years of the temporary absence rule. And I said to her, does he have a direct line with Canberra? She said, no, why? And I said, because Labor hates SMSFs. That was a bill proposed by Scotty from marketing before he got the boot, and it is sitting on the shelf gathering dust, and I don't think that will see the light of day. Needless to say, the advisor didn't respond to my comments regarding that. So to me, it's very dangerous to make assumptions based on proposals. It's good to take them into account and factor them in, but until they become legislation, do not rely on either the active members test being removed or the temporary absence test being extended from 2 years to 5 years.
Yep. And I mean, I'm laughing at the commentary around the accountant as well, because I caught recently an accountant recommending a $60,000 contribution to a client's super fund to use what's called the catch-up concessional contribution. They obviously hadn't done their research, but the client's super fund balance is over 500,000. So I was like, cool, you're going to get smashed with penalty tax. I was like, that's great. I can't wait to have a chat to this accountant, the idiot.
Well, it's twofold. Active members, you can't contribute, and B, you're exceeding the contribution caps.
Yeah. So
juicy.
So yeah, it was juicy, right? And I know you just shake your head a little bit and you do what you can, but that's okay. We caught it, so it's not going to be an issue. I do come across a lot of accounts providing financial advice, freebies, but they also wear no recourse. So if you were to end up maybe having a formal complaint against them, the accountant, they don't really have PI insurance which covers that. So you just end up into a bit of a legal action with them, I guess.
Look at the bottom of all their invoices and their notes. They actually say waiving liability and everything. But
that's the other exactly one, right.
With the most common one is people will apply their brother, sister, father, neighbour as their trustee, and it's called rubber stamping, and it's frowned upon, in our community, in the advice community, but also frowned upon by the ATO. And there's a debate I've got going on with a lady in Saudi right now, because she's insistent that because the trustees have all changed, they're off, they're just the beneficiaries, they're fine. And I said, well, that's one step. Doesn't mean the overarching ability to hire and fire has been changed. You can still kick the trustees out because you're the beneficiary. But I said, there's a nice little rule. And she brought her accountant into this email, not wanting to bag accountants. They do a brilliant job, but sometimes they overstep their mark when it comes to this sort of stuff. And, the accountant came back saying, no, it's fine. The trustee, there's a corporate trustee, you're nowhere on it. You're safe as houses. Yes, you use that word, safe as houses. And I said to him, will you do me a favour, look up section 295-95 or the Income Tax Assessment Act of 1997. and it goes through and talks about what an active member is. And in there, it says that for an active member to be part of that, being the trustee as well as the beneficiary, they have to have a balance greater than 50% of the account. It's like, really? So they have to actually have their own money in that. I said, yeah. Otherwise, they're a straw puppet. They're a, what do you call them? They're a fake head of the account. So needless to say, mea culpa. And he actually said, yeah, go with Brett's recommendation. Please wind it up. I'll start the process now.
I mean, it's such a big issue though that you've got to realize that you've got to really be careful of the consequences for running it. Because I think when we think about self-managed super funds, they were all the rage. People have been setting them up, a lot of them, even to invest in crypto, to be honest. But even probably about 10 to 15 years ago, they were super popular because people wanted to set them up and invest in direct shares because traditional retail super funds didn't really have that kind of flexibility and option. But in today's day,
you buy Nvidia, you buy raw Dutch Shell, you can buy whatever you want. 14 markets.
That's right. There is plenty of superannuation funds which actually have that kind of offering. You only really need a self-managed super fund if you need to, or if you're going to invest in property, which traditionally has been most suitable for what I would say probably business owners, to be honest, renting warehouses and using their business, those sort of things. That's a really old school strategy, but it's really great for business owners back in Australia, and then also maybe investing in commercial property for the long term. So that's when it might be suitable, but for those people, they're Australian residents. They can still be pulling and making the higher level decisions. Rubber stamping, you do run a really big risk, and often you do need to wind it up, roll it back to just a traditional APRA fund, APRA super fund, which is just a normal retail super fund on one of the platforms, and then you can hit the reset button. There's not too many providers these days. Because the only other option, if you are stuck, if you're in the hot seat and you're stuck and you can't sell a property and you're up shit creek without a paddle, excuse my French, is you convert it to a small APRA fund. And by doing so, you're actually nominating a company in Australia, which does it day in and day out to act as the essentially trustee. The new exec trustee. There's not too many of them that do it anymore. There's only probably 2 or 3 providers which do it. And I think they're getting out of it because it just becomes very complex, because essentially they're running and managing a super, which might have a property in it and some shares. They're charging you a fee to manage it. But then on top of that, you're also paying an accountant to do your admin and your annual audit and your tax return. So it actually becomes a very costly exercise just to maintain that self-managed super fund, where in reality you probably shouldn't have had it.
And if you're maintaining or trying to maintain your SMSF, 9 times out of 10, because you've got property in there, which is not liquid, it's not an easy asset to sell. But guess what? As soon as you become a small APRA fund, the trustees get to demand a sell down to have a diversified portfolio. They're not going to want to take on the risk, being the trustee, of a single asset class, a single asset inside a single asset class. We had that a number of years ago, and I think I talked about in the podcast a while ago about a client who had all of his employee shares in his SMSF, and one holding, one company. That was his whole superannuation account. And the APRA fund said, yep, no, happy to take him on board as a client, but we're going to recommend a sell down, which is what I recommended the client in the first place, and the client decided to choose to ignore both of us. So I don't know what happened about them. But long story short, if you do have property in an SMSF, it is complicated. You do need to seek advice, because there is no panacea or tablet you can take to quickly fix it. Just changing the trustees is not the answer.
That's right. There is no magic fix to that. And you might even have that kind of property investment set up where it's pretty hard to liquidate. It's like if you've got a commercial property, I've got a client that's had a commercial property for sale for the last 8 months because of where it's actually been located. So commercial property doesn't turn over quickly. And you are in a bit of hot water there, but you just need to seek advice so you have it structured correctly. That's all.
Yeah, no, definitely, mate. Well, I think I don't want to talk ad nauseum about this sort of stuff, but it's just a good reminder. People say, but I sort of advice, make sure you speak to people who specialize in that area. You wouldn't come to Atlas to talk about Centrelink allowances. We're licensed to talk about it, but we don't deal on a daily basis. Aged care pensions and that sort of stuff. So talk to the specialists. We just don't like seeing good people getting caught with bad advice. So
That's right.
let's wrap it up there, mate. Thanks for everyone's time. It's a quick one, but it's just a nice little, community announcement just to remind people that it hasn't changed. It may not change. Don't expect it to change unless advised otherwise.
Yep. Sounds good. Thanks for tuning in, guys. See you on the next episode.
Thanks, guys. Take care.